Welcome back. I want to spend a little time talking about the manufacturing industry. It's a very important part of our economy, and also these numbers go into the decisions made by the Federal Reserve as far as raising or lowering interest rates. Now, these numbers are depicted on a number of different scales, pretty self-explanatory, where we have here the red line represents the S&P 500 going back to the beginning of 2021, about 2 years ago. And then when the blue line represents the average weekly hours. And we can see both numbers hit a pretty significant high in January of 2022, and since then have both enjoyed a pretty steady decline to the downside. This very simply shows us the amount of weekly hours paid for the average manufacturing employee and the S&P 500. They're very closely linked because the S&P 500, like any stock index, really moves under the anticipation of higher or lower earnings. If we expect higher earnings because in part maybe for a greater demand for manufacturing, well, we would see those hourly earnings increase, and then stock prices would also move in anticipation of better than expected earnings. Here we have the average weekly overtime hours in blue and the S&P 500 in red, and the same relationship exists. If there's more overtime being paid, we could expect stocks to go up as well, because more overtime means more demand. Certainly for overtime, because that's a more expensive way to pay employees. Average weekly earnings here is in blue, and the S&P 500. Now here's a little bit of a divergence. Stocks since the beginning of 22 have come down, where the S&P 5, or I should say the S&P 500 has come down, and then the average weekly earnings continues to rise. So over the long term, the earnings for manufacturers continues to rise while stocks have taken a dip. This may represent a little bit of an opportunity, this divergence. We're going to talk about this in just a moment. Here we see also all manufacturing employees. This is the number of employees within the manufacturing industry, and the S&P 500. Again, stocks have come down, but the number of employees in manufacturing continues to rise over time. Average weekly hours and average weekly overtime hours, and there's a very strong correlation logically. If the expectation is that we have a heightened demand of manufacturing, we're going to have more weekly hours and then more overtime to capture that spillover in demand. Average weekly overtime hours in all manufacturing, a little bit of a divergence here. The number of individuals within the manufacturing industry continues to rise, but the weekly overtime decreases. Maybe this is a result that as there's a greater amount of people within the manufacturing industry, there's less of a need for overtime. Overtime is a more expensive way for a company to pay employees, and it's only really done if we really have the need for it. So the more people they hire, maybe the less overtime that's necessary. Average weekly overtime hours and the average hourly earnings, it's the same type of explanation, I would guess. As we pay more employees, we have more employees within a particular company, and then the overtime, the need for overtime falls. Now, very interesting here, take a look at the correlations. This goes back about 1 year. We look at the relationships between these different numbers. So for example, the average weekly hours and the average hourly earnings, there's a 65% negative correlation. A negative 100% correlation means that when one index goes up, the other goes down by exactly the same amount. If there's a perfect relationship, you'll have a 100% positive correlation. Correlations below 50% or above negative 50%, closer to zero, those don't mean a lot. What we're looking for readings of greater than 50% or less than negative 50%. So for example, take a look at average weekly hours and average weekly overtime hours. 84% positive correlation, which means as the weekly hours increase, the average overtime hours also increases. Now, we just took a look at that chart, and there's very logically a reason why that's the case. Now, these correlations are plotted going back 1 year in data, but take a look at the long-term correlations. These go back to 2015. It's the same data, but now we're taking a much larger picture of the data. In particular, consider the average hourly earnings and the S&P 500 over the past 8 years or so, 2015 through present day. We have a 93% correlation, meaning as over the past 8 years, as the average hourly earnings goes up, so does the S&P 500. When the average hourly earnings goes down, so does the S&P 500. So here's a picture of that. Average hourly earnings is in blue, S&P 500 is in red. But go back for a second. Focus again here. This is a square. The average hourly earnings in the S&P 500 is a 93% positive correlation on a long-term basis. This is over 8 years. But take a look at the correlation over the past 1 year. 75% negative correlation. Again, 8 years, 93% positive correlation. The past 1 year, a negative 75% correlation. So we take a look at the positive correlation over the long term. This is an 8-year chart. Again, the blue line is the average hourly earnings. The red line is the S&P 500. They both tend to go up together. But take a look over the past 1 year. Over the past 1 year, the S&P 500 has gone down, whereas the average hourly earnings has gone up. Now, anytime we have a divergence where two indices that we think should go together, when they begin to separate, this represents an opportunity, because over the long term, we would expect a regression to the mean. We'd expect the red line to start to go up or the blue line to start to go down. They should stay together. They have stayed together for the most part. So what's going to be the result? Well, we don't know. Maybe there's some sort of arbitrage opportunity here. If these are two stocks, then certainly there would be. But in this case, we can say, well, either I think stocks are going to go up, or maybe average hourly earnings are going to go down. Well, if you expect average hourly earnings to go down, maybe we look at some manufacturing stocks within the manufacturing industry, and take a look at their earnings. Try to anticipate if maybe we expect those earnings to go down. Maybe those stocks will start to lead the market lower. Consider also the long-term correlations, the average weekly earnings and the S&P 500. Over the past 8 years, a 94% correlation, a very strong correlation. Right over here. However, take a look at that number over the past last year. 94% becomes negative 73%. Again, 94% over the past 8 years, 73% to the downside, a negative correlation over the past year. So we take a look at the average weekly earnings and the S&P 500, very strong long-term correlation. Even in 2020, the early 2020 level, when we had this big dip, they almost mirrored each other. As the S&P 500, the red line went down, so did average weekly earnings. But take a look at this number over the past year. All of a sudden, we see a big divergence. S&P 500 goes down, the average weekly earnings goes up. Well, what will be the result of this? Of course, we don't know, but we expect either the broad S&P 500 index to resume its long-term correlation to the upside, or perhaps we see average weekly earnings start to go down. And again, to translate this into some sort of trade or investment strategy, maybe we'll look to those manufacturing stocks. If we start to anticipate that their earnings are declining, maybe we'd expect that to move in the same direction as the S&P 500, which right now looks like it's going to the downside. Or we could take the opposite side of the trade and say, well, if we think that average weekly earnings, I should say, or hourly earnings for that matter, will continue to rise, whatever's dragging down the S&P 500, maybe that will turn back to the upside. But the point being is that when we have a divergence between the long-term correlations over the past 8 years and the short-term correlation over the past year, when that divergence exists on a short-term basis, but a convergence that exists on a long-term basis, then certainly there may be an opportunity for us. We're going to continue to watch these numbers very closely, and we'll be sure to update you along the way with any significant changes at all. We hope this has been helpful. We look forward to seeing you back soon.